Okay, hi everyone. I want to start on chapter 9 today. So I want to start off by recapping on the concept of the statement of financial position. Now you have all learned about double entries. You have also learned about income statement. Let's recap. Income statement is one of the financial reports at the end of the year. Is to determine whether the company made a profit or loss for a particular period, whether it is a month, a year, or 3 months, it is for a period. Now, the difference with statement of financial position. Now, this is the second statement that we do every accounting period end. Statement of financial position. Now, this is the statement that we are going to talk about. So, you have done on income statement. Now, we are going to look at this second statement. This is chapter 8 you have done, and today we are going to start on this from chapter 9. So you should be referring to chapter 9 of your textbook. Now, this statement of financial position, it is as at a certain date. Okay, so the difference compared to income statement is you are really talking about the position of the company as at a certain date. Okay, and it will report on all the assets, on the capital, and the liability of the company as at this date. Okay, the statement of financial position will report all the assets, the capital, and liabilities of the company as at that date. So clear for income and expenses, as at the end of the financial year, you will transfer the income and expenses account to income statement. Even your sales account, your purchases account, your return inwards account, your return outwards account, all those accounts, those amounts, you will transfer to income statement. But for those accounts that are assets, for instance, your premises, your furniture and fittings, your motor vehicles, office equipment, asset accounts, or even your capital account or drawings account, or even liability accounts, trade payables, loan from bank, all these accounts that fall under any of this category, what you do is as at end of the year, you will do a balancing, and you will have balance carried down, balance brought down. Now, the balance carried down figure is where you will put into the statement of financial position. So really, the statement of financial position, the purpose is to show any person, to show the accountant and the owners of the company as at this date, how much does the company own? How much does the company owe? What does the company have? Okay, and really this statement, it is based on the accounting equation. Can you all remember what is our accounting equation? Okay, accounting equation is asset equals to capital plus liabilities. That is our accounting equation. So if at the beginning of the business, the owner invested 20,000 in bank, and that is the capital, the company would have in bank 20,000, and the owner would have invested 20,000. So you have 20,000 capital, 20,000 asset. So the accounting equation is equal. Okay, you follow? At all times, this accounting equation will always equal at all times, no matter what transaction happens. Let's say if out of the 20,000 in the company used 2,000 to buy computer. Okay, then now you have bank, 18,000 left because 2,000 was paid up. But now the company has a new asset in the form of computer, and that is the value is 2,000. So no change in terms of total asset, but it's just that it has 18,000 now cash and 2,000 worth of computer. It is still total assets 20,000. Capital also no change. Liability is 0. So the accounting equation is still equal. Do you see that? Two transactions have happened, excuse me. Now the third transaction, let's say the company takes a loan from the bank of 5,000. Now, what is your accounting equation now? With 5,000 loan, the company receives money of 5,000. So now your bank increases to 23,000, because now 18,000 plus the 5,000 money received from the loan is 23,000, plus the company still has this computer, 2,000. So total asset is now 25,000. Then on this side, your capital is still no change, 20,000, but your liability is now 5,000 because you owe the bank 5,000. So this side is 25,000, this side is also 25,000. Do you see the trail? At all times, asset always equal to capital plus liabilities. In any company, it is like that. Because anything that the company own, the asset, whatever resources the company has, it has to be either invested by the owner or borrowed from an outsider. That's why this equation will always hold. And if you understand this framework, this concept, really the statement of financial position is a reflection of the accounting equation. Now let's look at the statement of financial position in your textbook. Okay, let me just adjust this to, hopefully you can get a better, okay. Now, is it clear to all of you now, the statement of financial position? This is from page 115 of your textbook. This is a sample statement of financial position. Okay, so take note, the name of the company, okay, and then the heading. You always say statement of financial position as at, because it's as at a certain date. This is as at 31st May. But maybe by 1st June, your statement will look differently already by the next day, because maybe people who owe you money would have paid, and then your total assets would have changed already. So that's very important, the heading. Now, here you see, so there is this assets at the top. This is the vertical format. There is also a horizontal format. But for now, we will focus on the vertical format because I don't want to confuse you, okay? So if you read the assets, they have non-current assets and current assets, okay? Now, this company has premises, which is your land and building, and fixtures and equipment. They have two types of non-current assets. What do you mean by non-current assets? Non-current assets are long-lasting assets. Assets where the value tend not to change after 1 year. Okay, assets where that can last for more than 1 year, then they will be positioned as non-current assets, like premises, fixtures and fitting, office equipment, furniture, computers, motor vehicles. These are all non-current assets. So whatever the company has as non-current assets, they will first list down and then they get a subtotal. Then they go on to the current assets. Current assets are assets where the value changes. It's either the value changes within 12 months. Okay, that is normally 12 months is normally the period that we determine whether they are current or non-current. So inventory, why is it a current asset? Because the value of your stock will change, right? Every day when you sell new stock, when you buy new stock, the value will change. It changes within the 1 year period. So that's why it's listed as a current asset. Even these trade receivables, these are people who owe you money. Why is it current asset? Because today, this person may owe you money. Tomorrow, they may pay you money. So this amount is also constantly changing. Bank and cash also constantly changing. So all these are the current assets that the company own, and it gets listed here. Now, if you look at this format, I would prefer that this whole current assets, the whole figures, the whole four figures, be transferred to this column here, the middle column. Okay, so that you can get 1, 2, 3, 4 figures here, add up the subtotal, and then put the subtotal here. So you have a subtotal of current asset to add to your non-current asset. For presentation purposes, I just think it's better for these 4 figures to be transferred to this side, and then add up to get a subtotal, and only the subtotal put here to add to the non-current asset. Okay, now so you can see from here, understand the flow of the statement. Non-current asset plus current asset, then you get total asset. In your accounting equation, this is your total asset figure. So total asset equals to capital plus liabilities. Now the bottom part is the capital plus liabilities, because you can see this is the capital portion and this is the liabilities portion. Capital plus liabilities equals to total asset. That's why this final figure and this final figure must agree. If you have done your T account properly, then these two totals should agree when you do your statement of financial position. And so A equals to C plus L. Okay, and what is in A is based on your T account, what you have bought during the year. What is in C is basically your opening balance. That means your capital brought forward from last year. But if it's a first year of business, then it's really originally what is invested by the owner. This will be from your capital account. It's always capital account opening balance plus profit. But if it's a loss, then will be minus loss. Okay, then less drawing. Then you get the closing capital balance. This 94,006 will become your opening capital for next year. Is it clear? Okay, and then on the liability side is basically if you have non-current liability loan. Why is it classified as non-current liability? Because obviously this loan is the repayment period is more than 1 year. So any loan where it's due after 1 year, let's say it's a 3-year loan or 5-year loan, automatically you classify as non-current liability. Then under current liability, they have trade payables. But if it's a bank overdraft position, the bank overdraft will also come under current liability. Then you have your total liability figure. So non-current liability plus current liability plus capital figure, then you get your capital plus liabilities total here. Okay, take some time to understand this statement of financial position. So remember, all these figures are actually the balance carried down. When end of the year, you balance all your account and capital and liabilities account, you just plug those figures and put in here. Or alternatively, the question will give you a trial balance, and then you just put in all the asset, capital and liabilities amount into this framework. So it's very important for you to understand the flow of this statement, because different company may have different asset, different liabilities. If you understand the flow of this statement, it's just a matter of putting in the figures. Okay, so this chapter is quite simple. Now, let's look at the horizontal format. Okay, you can see the horizontal format is like your T account format. There is actually a central line here. Okay, and on this side is the C plus L. On this side is the total asset. Do you see that? This one is the non-current asset. This one is the current asset. Then total asset figure. This side is the capital figure. Okay, capital figure. This side is the liability figure. Then C plus L total here. So it's just rearranging your figures, but actually it's not difficult. Okay, so I will be posting out these two sample of statement of financial position from your textbook, and I would like you to do question 1, 2, 3 of your textbook. I will also post this up for those who don't have textbook, and then question 4 and 5. Okay, 1 to 5. So question 1 to 5, chapter 9, that will be your work. So question 5 is quite easy. What they have given you is the trial balance. You just have to use the figures from this trial balance, do up your income statement and your statement of financial position. Okay, I want you to do this work today, and then please post your answers by Monday. Okay, post your answers by Monday. I will put these instructions down on Google Classroom as well. Okay, any questions? I'll be seeing you on Skype tomorrow. Please ask me if you have any questions. Tomorrow, I will also take time to run through some of the previous question if they on income statement. For those of you who have not posted your marking and your answers, please do so before our Skype meeting tomorrow. Thank you.